On July 22, U.S. President Donald Trump announced what he described as the largest economic deal with Japan in history. The agreement includes reciprocal tariffs and a massive Japanese investment in U.S. projects totaling $550 billion, equivalent to around 3.8 trillion Chinese yuan or 422 billion euros. President Trump emphasized that the United States would impose a 15% reciprocal tariff on select Japanese goods and services. In return, Japan would open its markets further to American products, including automobiles, trucks, rice and other agricultural commodities. According to Trump, the deal will yield significant economic benefits for the U.S., including the creation of hundreds of thousands of jobs and a dominant share, reportedly 90%, of the profits from the Japanese investment. While the U.S. administration framed the outcome as a resounding success, public reaction in Japan was mixed, with some domestic observers drawing historical parallels and questioning the long-term implications of such a commitment. For many in Japan, the announcement brought back memories of the 1985 Plaza Accord, a landmark agreement between the United States and several economic powers aimed at correcting trade imbalances. At that time, Japan was experiencing an economic boom, and the United States sought to reduce its growing trade deficit by pushing for a devaluation of the U.S. dollar. Under intense American pressure, Japan agreed to revalue the yen, which surged by nearly 50% against the dollar in a short period. While the U.S. achieved a temporary trade advantage, Japan's export-driven economy suffered a sharp contraction. The yen's rapid appreciation triggered asset bubbles that later collapsed, leading to a prolonged economic stagnation known as the lost decades. Many Japanese analysts and economists still view the Plaza Accord as a turning point that stunted Japan's economic rise. Today's agreement, though different in scope and context, has reignited that historical sensitivity. Critics have suggested that Japan once again faces pressure to prioritize U.S. strategic interests, raising questions about the balance of power in this bilateral relationship. The core components of the new U.S.-Japan agreement include 15% reciprocal tariff. The U.S. will impose a 15% tariff on a range of Japanese goods. The exact product categories and implementation timeline have not been publicly disclosed, but it is expected to target sectors with significant trade volume. $550 billion investment in the U.S. Japan has agreed to invest $550 billion into various U.S. sectors, reportedly including infrastructure, clean energy, technology, and advanced manufacturing. These investments are expected to support American jobs and local economies. Market access for U.S. products. Japan will open its markets more fully to U.S. agricultural goods and automobiles. This is a sensitive area, especially for Japanese farmers, whose industry has long been protected through tariffs and subsidies. Profit-sharing arrangement. President Trump stated that the United States will receive up to 90% of the profits generated from Japan's U.S.-based investments. This figure has not yet been independently verified, and analysts are seeking clarification on how this profit-sharing mechanism will be enforced or calculated. In Japan, the announcement triggered significant public scrutiny. Social media and online forums saw a surge of criticism, with many users expressing concern that the agreement compromised national interests. A recurring theme was frustration with perceived capitulation under foreign pressure, particularly regarding the sensitive issue of agricultural imports and foreign control over domestic investment outcomes. Prime Minister Shigeru Ishiba, who was reportedly instrumental in the negotiation process, faced calls to resign from some members of the public. Critics labeled the agreement as overly accommodating and expressed fears that Japan's economic autonomy was being undermined. Japanese officials, however, defended the agreement, portraying it as the product of hard but necessary negotiations. They emphasized that the investment would strengthen the country's diplomatic leverage and secure a strategic partnership with its most important ally. Despite the domestic criticism, Japan's willingness to accept these terms may reflect broader strategic considerations. As geopolitical tensions in the Asia-Pacific region increase, Japan has aligned closely with U.S. foreign policy in recent years, particularly in counterbalancing the rise of China and maintaining stability in the region. By deepening economic ties with the United States, Japan likely aims to strengthen its diplomatic position and ensure continued American security support. Japan's reliance on U.S. military protection, particularly under the U.S.-Japan Security Treaty, remains a central pillar of its national defense strategy. Moreover, the investment in U.S. infrastructure and industries could open doors for Japanese firms to access new markets, technologies, and long-term returns, though critics argue that these benefits may be offset by the restrictive profit-sharing terms outlined by Trump. The economic implications for Japan are complex and multifaceted. On the positive side, participation in large-scale U.S. projects could provide Japanese companies with lucrative contracts, exposure to American innovation and long-term investment returns. However, the concessions on agricultural imports are expected to have a significant impact on Japan's domestic farming sector. Rural regions in particular may struggle to compete with cheaper U.S. imports, raising concerns about food security, farm livelihoods, and long-standing cultural traditions. Economists are also questioning the feasibility of the 90% profit figure mentioned by Trump. Without detailed documentation, it is unclear how profits will be measured and distributed. If the terms are as lopsided as they appear, the financial benefits for Japanese stakeholders may be significantly diminished. For the United States, the agreement represents a substantial economic win, at least in political terms. Trump has positioned the deal as a symbol of American strength and a validation of his aggressive trade policy approach. By securing major foreign investment and expanding export opportunities for American goods, the agreement is expected to resonate with voters focused on economic recovery and job creation. Moreover, the announcement allows the U.S. administration to showcase its ability to command favorable terms from even its closest allies. This narrative may help reinforce Trump's image as a strong negotiator ahead of the next election cycle. Still, some U.S. economists have warned against oversimplifying the benefits. While foreign investment can be a major stimulus, the sustainability and fairness of the profit-sharing terms will require ongoing scrutiny to ensure they do not undermine long-term bilateral cooperation. Beyond Japan and the United States, this agreement may send a broader signal to other American allies and trade partners. It illustrates the continued leverage that the U.S. holds in economic negotiations, and the lengths to which even advanced economies may go to preserve diplomatic alignment. Some observers view the deal as part of a larger shift toward transactional diplomacy, where economic partnerships are increasingly evaluated through the lens of short-term gains and strategic advantage. Others worry that such deals could erode the spirit of multilateralism and fair trade practices that have underpinned the global economic system for decades. Whether this agreement marks a win-win partnership or a disproportionate concession depends largely on how the details unfold in practice. If managed well, the $550 billion Japanese investment could strengthen economic ties and create genuine opportunities on both sides of the Pacific. But if the profit-sharing terms and market access commitments prove too onerous for Japan, the long-term consequences may include political fallout, economic strain, and a recalibration of Tokyo's approach to international cooperation. This landmark trade deal comes at a time of global uncertainty and shifting alliances. While both nations have publicly affirmed the value of their partnership, the underlying dynamics reflect deeper questions about power, sovereignty, and the cost of strategic alignment. As the full impact of the agreement becomes clearer, the world will be watching to see whether it serves as a blueprint for deeper cooperation, or a cautionary tale of economic imbalance in an era of high-stakes diplomacy.